Let's stay with that RBA rate decision. We had a quick look around the place. We can't see anybody moving their rates as we go to air right now. I did speak a little earlier with Sally Tindall, Research Director at interest rate monitoring company RateCity. She's adamant the big banks, though, will pass this rate rise on quickly.
It will be passed on in full by the vast majority of banks. That's what's happened in the last 10 hikes. Can't see any reason why it wouldn't happen on the 11th, Ross. And so for the average borrower, that $500,000 loan, they're looking at a $78 increase to their mortgage repayments in total across the 11 hikes. So $1,058. We've broken the $1,000 barrier. That's every single month. It's not a one-off expense. It's not like a trip to the dentist that you weren't expecting. It's every single month.
So you sit there and you have a look at that. So more than $1,000. So we're talking, $13,000 a year for that person with that $500,000 loan. But the median loan in Australia is about $750,000. So for that person, you're talking now significant amounts of money, $18,000, nearly getting on to $20,000 that person's having to bear. After tax, that's a big wedge of a typical household income these days. It's around $100,000.
Oh, absolutely. They are putting the full force of these 11 hikes to squeeze people's budgets so that they don't do any discretionary spending or as limited as possible. And for some families, particularly lower income families that might have a mortgage still, they are really feeling the heat. Those people that bought at the peak also really under some extreme pressure right now.
And then there's also the people coming off the fixed rate loans. There was said to be 880,000. The Reserve Bank was monitoring those families. The government was monitoring those families. But now we're getting towards halfway through the year. More and more people have already come off those fixed rate loans in the past.
Absolutely. And they're coming off and they seemingly are surviving this fixed rate cliff that they have to climb. Last time I checked in with Westpac, they said that, mortgages in arrears by 30 days have ticked up, but nothing significant. We're still got, relatively low, levels of default at the moment, which means families are coping. What they're doing is refinancing, Ross, or at least haggling with their own lender.
And that seems to be the issue because banks are reporting that margins are getting squeezed because they're having to compete for the loans. At the same time, they're having to give more to the savers. So that's squeezing bank margins, and they've now got to make a decision as to whether they want to be in the market and try and grab more mortgages or whether they stand back and really allow that profit, that market share to go to another rival.
They are struggling to work out whether they are Arthur or Martha at the moment. They want to foot in both camps. We've seen all four big banks repeatedly now shave down those new customer variable rate discounts. The really big discounts that were on the table at the end of last year, they've been pared back slightly because they just can't be handing out such big discounts on the volumes that we're seeing with refinancing coming down. The interesting one is fixed. It's coming down now as well. But
that's almost a sucker's play.
A little bit.
I want to say this too, because look, anybody who's watching, it is a bit of a sucker's play because the banks know when rates are close to peaking, they'll do all sorts of things to get you locked in at those higher rates, knowing that they're the big beneficiaries if interest rates fall in the future.
Look, fixing suits some people, but you've got to look at the market. You're probably not going to have a crystal ball and know exactly what the cash rate is going to do. But just know that when a bank tries to lock you in for 3 or 4 years, that is of a benefit to them because you can't really refinance without paying hefty break fees. And you've got all four economists predicting cash rate cuts in 2024. So, really have a long, hard think about whether fixing is right for your finances. And if you do decide to fix, not many people are. I think the latest stats showed that just 5% were fixing. If you do, there is daylight between an uncompetitive rate and a cracking rate.
OK, just ahead of this, as you were starting to look at the market, what was the difference between some of the higher rates, home loan rates in the market and some of the lowest? So what was the differential there?
Well, look, right now, after this hike filters through, we think that the average owner-occupier who hasn't negotiated their loan since the start of the hikes is now on a rate of 6.61. They're almost at 7%.
Yeah, that's right. So it's pretty that's a big rate as compared with where they were.
An ultra-competitive rate, though, after this hike filters through, will still be 5.25%. So there you go. It's just it's a huge difference of well over a full percentage.
So even after this rate rise, what you're doing is the line in the sand should be around about 5.25%, 5.5%.
Correct.
If you're around about that mark, you're pretty much on the money.
Yes.
If you're over that, you probably need to be renegotiating lower.
I think that's a great way to put it. Look, the most cracking rates 5.25%, but the big four banks after this, most of them will be over 5.5%. So there you go.
Sally Tindall from RateCity, always good to chat to you. Many thanks for your time today.